I guess, Jason, maybe we can start. We've got a good chunk of people online, and we
Okay,
only have
great.
an hour, so I don't want to
Yep.
sort of start late and then we'll be pressed for time. So
Yep.
maybe we'll, first of all, everyone who's online, welcome. Thank you for joining us in today's webinar. Topic today will be the U.S. elections and the impact on the international energy markets. Today, I'll be speaking to you, Richard Sultanian from NUS Consulting here in Park Ridge, New Jersey. And with me, I have Jason Durden. Jason, I'll let you introduce yourself.
Yep.
Yep. Um, if you have any questions throughout our presentation today, please put them in the chat. We'll do our best to get to them and try to answer them as they're posted up. In the event that we can't get to all of the questions today, we'll do our best to circulate notes around to all the offices and to any individuals who send us questions about today's topic. So with that, I guess maybe we'll launch off in today's topic, and we'll start with probably a bit of background, which is the election results. As you know, the U.S. held its elections roughly a week or so ago. The election results were forecast to be very close. Turns out very early on Tuesday evening, that was not the case. What we found out early on that it was going to be a win for the Republicans and for Donald Trump. In the end, President-elect Trump won not only 312 electoral votes, but for the first time since 2004, the Bush election, he also won the popular vote. This was quite surprising, I think, to most pundits who expected this to be very close. In the end, Trump won all of the vital swing states. Quite surprising result based upon what people had been forecasting. And just as important, Trump gained ground in many of the Democratic strongholds. So he claims today to have an sort of an unprecedented mandate of it coming into office in January. This appears to be the case because not only did Trump win decisively the White House, but they also took control of the Senate, which was evenly split during the Biden administration. And after many days of additional counting, he has now control of the House as well. This is quite important. If you think about it, the Trump administration 2.0 coming into office in January will effectively control all of the most important levers of government in the United States. He will control the White House, he will control the Senate and Congress, and in effect, he controls the Supreme Court as a result of his appointments in his first term. As a consequence, he's in a very strong position to move his agenda, which is unusual because the United States is typically, one of the functions of government here is it's typically split, and as a consequence, there's a lot of negotiation, a lot of stalled or prevarication on the movement of large initiatives. This doesn't appear to be the case with Trump 2.0. As such, we thought it'd be important to start to review some of Trump's more important policy promises during the election and how those will impact the global economy as well as the energy markets. Before we jump into discuss his policies, one thing that I think is extremely important to review is that Trump is coming to office in a very different position this go-round than the first go-round. And so what we've done here is done a little bit of a comparison between 2016, when Trump first took office, and the start of 2025, when he's scheduled to take office in his second term. And I think the first very important point is in his first term, Trump was surrounded by traditional conservatives who had a great deal of experience in government. And as such, maybe to his internal frustration, but acted as guardrails against a lot of his impulsiveness. And as a consequence, had a much more traditional policy going forward and a little bit more consistency to it. In his second term, what we've seen by a number of his appointments, and we'll talk about that in a bit more detail when it comes to the electricity side or the energy side, Trump is surrounding himself with loyalists who have very little experience in government and whose real agenda is to move his MAGA agenda and his policies. So we are starting from a very different place in that sense. The second item is a big centerpiece of Trump's policies during the election cycle were tax cuts. He promised tax cuts on overtime, Social Security, no taxation of Bitcoin. There were numerous promises made. Another interesting statistic to look at is the status of U.S. outstanding debt. In his first term in office, outstanding U.S. debt was 20 trillion. Coming into office as of today, which will be larger in January, the U.S. debt is sitting at 36 trillion. As a consequence, the opportunity to cut taxes without some sort of offsetting spending cuts will be much more limited if fiscal responsibility is an issue that they wish to address. Next item worth reviewing is U.S. crude oil production. In 2016, U.S. crude oil production at the start of his administration averaged 8.8 million barrels per day. In 2020, today, at least current production stands at 13.4 million barrels per day. And if you look at the chart at the top of this slide, this is crude oil production from the year 2000 to today. And you can see during the Trump administration, we did see a growth. We did see growth in crude oil production, but likewise, we saw significant growth during the Biden administration. So while Biden was supportive of the green energy transition and supportive of sustainability, crude oil production did continue to grow apace. The same can be said for LNG exports. If you look at 2016, at the start of Trump's initial term, U.S. exports of LNG were quite modest at 186 billion cubic feet in 2016. In 2023, that had grown to 4,343 billion cubic feet, and is growing and is continuing to grow. Infrastructure is still being built at this time, and the bottom chart here shows LNG exports from the U.S., and that has grown exponentially over both administrations. Last 2 points to highlight as Trump comes into office is first, on his first go around, Trump walked into office with the federal funds rate and interest rates basically at zero. Today, he's going to walk into office with interest rates hovering somewhere around 4 3/4, which has significant impacts on economic development and the opportunity to implement policy, as well as the interest on U.S. outstanding debt, which we spoke about before, is sitting at 36 trillion. The last point to highlight in the differential of how he takes office is foreign entanglements. In his first term, there really was no hot wars. There certainly were areas of concern, but this time as he walks in, you've got the Ukrainian war, you've got the conflict in Israel with Hamas, Hezbollah, proxies of Iran, and you've got tensions growing in the South China Sea. So he certainly is walking into both an economy and a foreign entanglement situation that is vastly more complex than the first go around. And he will be surrounded by people with less government experience, but certainly people who will be looking to implement his agenda on a much more full-throated basis. If we turn to his domestic policies, as we said, we can break those down into two main groups. Yeah. The domestic ones, which we've highlighted here, the first, as we discussed earlier, tax cuts. Centerpiece for Donald Trump's campaign were tax cuts. He wants to extend the 2017 tax cuts that were passed by his initial administration. These are scheduled to expire or sunset in 2025. In addition, he wants to cut the corporate rate, eliminate tax on tips, overtime pay, and Social Security. The chart to the right shows the U.S. annual deficit since 2000. And you can see the two highest spikes here were COVID related, but nonetheless, the trajectory of U.S. deficits has been increasing exponentially. As a consequence, his tax cuts, if he gets them through, will certainly be positive for domestic growth, but will no doubt exacerbate the country's deficit and debt problems unless they find significant spending cuts, which they haven't spoke of or delineated other than Elon Musk and Ramaswamy's efforts outside the government to find efficiencies and reduce spending. This sort of non-governmental group that he's building doesn't have legislative authority or any authority inside the government. So it will be very interesting to see how they will be able to move any of their recommendations through the governmental channels that will require some level of approval. Second main domestic policy pillar from Trump was deregulation. He's really wanting to focus on deregulating certain aspects of the economy. First is banking. Second, which we'll focus on in this presentation, is energy. And finally, technology. Again, these are clearly designed to support domestic growth, corporate earnings, hopefully from his perspective, to support the stock market as well, but also support M&A activity. And then finally, the push in energy, which will be a focus of our discussion. Trump is looking to limit the incentives that were under the Biden signature legislation, which was the Inflation Reduction Act, which included a host of clean energy programs. So this will certainly be one of the things he's looking to cut. The second is we expect him to exit the Paris Climate Agreement. Third, he will most likely streamline and expand drilling permits on federal land. He will lower EPA motor vehicle emission standards, which will then tilt people away from EVs and the like. It will be very interesting to see how Musk responds to this, although it seems like Musk has already got a bit of a plum in that it looks like self-driving regulation is about to be passed much more quickly than most people expected. And then finally, we're expecting him to ease the clean air guidelines that were increased under the Biden administration for utilities. The impact from the energy perspective will most likely be supportive of domestic industry and manufacturing locally. It may have a negative impact on global economic growth as the U.S. sort of pulls itself out of more international engagements. So these are issues that certainly will ripple throughout the globe. As we turn our attention to the international side, Another signature policy for Trump was immigration. A big part of his campaign was eliminating asylum privileges and reinstating a stricter border policy. This appears to be something that's gaining momentum across the globe, but also deporting undocumented and illegal immigrants and restarting construction of the wall. He has stated that he'd be looking to deport up to 10 million undocumented immigrants and aliens. Personally, and from a viewpoint of just logistics, that will be an extremely difficult thing to do. However, it is possible that he may be able to accomplish 2 to 3 million, particularly for people who are being held today or recently have been let into the country. So there's no doubt particularly with the nominees and picks he's made for his cabinet, this will be a big push he makes. One of the impacts of such a policy will be to counteract some of the other things that we talked about. This will be negative for U.S. domestic growth because it risks supply shortages and stoking inflation, which will be very difficult in the environment that he's taking office in. Probably the most important thing from an international standpoint that Trump has vowed to do, I think he's called it the most beautiful word in the English language, is tariffs. His longstanding view is the imbalance, the trade imbalance the U.S. has with other countries is effectively the U.S. being taken advantage of. As a consequence, he's looking to impose tariffs across the board. Generally, he's looking to impose 10 to 20% tariffs on all imported goods coming into the United States. He's talking about imposing a 60% tariff on all goods coming in from China. And further, and something that hasn't been focused on a lot, he's talking about tariffing specific industries and countries. And a good example of that is cars coming in from Mexico into the US as part of the NAFTA, or the new version of NAFTA that his administration put through. This clearly will have a detrimental impact on global economic growth. One of the reasons probably we've seen oil sort of plumbing the depths that we have seen. In addition, he's hoping that it will be supportive of domestic industry and manufacturing, but no doubt the Trump administration is moving back towards probably a 1920s and 1930s mercantilist approach to policy, which will upset 50 years of U.S. open trading policy from the standpoint of both economics and foreign policy. If he accomplishes this, which he can do without legislative approval, this will certainly send shockwaves across the globe. And the final issue from a foreign policy standpoint is that he has pledged to alter the relationships with NATO, which he sees as a very one-sided relationship. He's also claimed to quickly resolve the Ukraine war. Today, we had important news on that, and we will certainly be looking at the impacts of that and reinstitute stronger sanctions on Iran. This approach will no doubt increase market and commodity volatility and will negatively impact the business sector. Just very quickly before I pass over to Jason, looking at the situation across the globe today, there are three main hotspots that we really need to take account of. Clearly, the Ukraine war. This has been now, sort of in place since February 2022. It has taken a tremendous amount of resources and manpower and material. There has been significant, let's say, Russian activity both in the Luhansk and Donetsk area in the last several months. There has also been, Ukraine taking territory in the Kursk region. It seems that this is going to continue to roll forward until Trump takes office. And what we've seen currently is both sides increasing their level of activity, attempting to get in the best bargaining position they can. We'll see if he's able to complete his policy promise, which was to resolve this matter before he takes office. We think that's highly unlikely, but he will certainly bring a tremendous amount of pressure onto Ukraine in order to try to get a resolution going forward. One of the important parts of any discussion on Ukraine, it will focus on the territorial result of a negotiation. How much territory is Ukraine going to give up as part of the negotiations? But in reality, from our perspective, from an energy perspective, the most important points that we'll be looking at is part of any deal, is there a lifting of sanctions on Russia and Russian organizations like Gazprom? Because if that does, it certainly will change the energy dynamic. We will also be looking to see if any resolution or negotiation impacts the negotiation on the transit agreement on the Ukraine pipeline. And then finally, we'll be looking to see if there are any security guarantees, for example, admission into NATO or into the EU for Ukraine as part of this deal. So I think all eyes from a European perspective and energy perspective will certainly be on this negotiated settlement that they will be pushing for. The second theater that's absolutely critical is the Middle East. As a result of the October 7 Hamas attack, Israel has been on the offensive with regard to Gaza and with regard to Lebanon and attacking both Hamas and Hezbollah. They have been immensely successful in trying to degrade Hamas's and Hezbollah's capabilities. As a consequence, there has been attacks between Iran and Israel. These attacks have been fairly limited to date. However, that is one of the consequences of the Biden administration pushing very hard on Prime Minister Netanyahu and his government to try to limit any direct conflict with Iran. The advent of President Trump and his new administration, and particularly the people that he has been appointing, points to a very different approach, and most likely less restrictive on Israel's capability to strike Iran. It looks as if Israel looks at this conflict today as a historic opportunity to provoke regime change in Iran. That being said, that creates a significant risk to a significant amount of energy flowing through both the Persian Gulf and the Red Sea. As a consequence, and Jason and I will review this going forward, there is a heightened risk of much more market instability as a consequence of a change in policy when it comes to the Middle East. And the last area, which is not a war, obviously, but the tensions are certainly rising in the South China Sea. Between the 9-dash line, where China has claimed a significant portion of the South China Sea, China has been building, artificial reefs and has built several military outposts which act as stationary aircraft carriers with missile bases. And there is little doubt that it is practicing for an invasion of Taiwan. The question will be, with a change of U.S. administration, will that change China's timetable and political positioning in the South China Sea? This was yet to be seen, but certainly an area of great concern. So I think these are the three hotspots that we will be watching very carefully and how they impact the international energy markets. maybe Jason, is a good opportunity to pass this over to you to talk about the oil markets. Yeah.
Thank you, Richard. Yes, hello everybody. My name's Jason Durden. I'm head of energy markets and risk management for Europe here at NUS Consulting. In the next slide, we'd like to sort of point out some key data points that really sort of define where we are and give us some clue as to why things may develop. In terms of the first chart, you can see global oil demand 21 to 25. The one thing I will point out, obviously, the recovery from COVID, but also we're going to move into 2025 as what is forecast to be the first year that oil production globally exceeds demand since 2022. That I think, as we'll discuss later, is quite key. Within that, the US total product supplied in 2023 was 20.3 million barrels a day. Now, there is crude oil production of 12.9 million, and we know from what Richard was saying a few moments ago, it's already this summer peaked at 13.4 million barrels a day. So even before Trump arrives with his deregulation and drill baby drill mantra, I think we can see that the crude oil production has been, a one-way trade for throughout the Biden years, effectively. Obviously, that is developed into oil exports, which the last set of data for 23 shows at 8.3, and crude oil imports. And I think this is quite important, and we'll look at the pie chart here. Crude oil imports of up to 6.5 million barrels a day. And we'll discuss this in a moment, I think. But in terms of what we're looking at in tariff imposition, is that between just Canada and Mexico, the US imports 4.5 million barrels a day of crude. As we understand it now, that will be subject to a 10 to 20% tax. And I think that clearly is something that has significant implications.
Sorry, Jason, I'm just going to point out one item here. Some of you may be asking, why does the US export 4 million barrels and re-import 6.5 million barrels? And that's because a significant amount of the crude oil that's produced in the United States is quite light in variety and in grade. And our refining capacity is designed for quite heavy crude. And as a consequence, we export a significant amount of the light crude to other countries that have that type of refinery capacity. And we import more dirty crude that is more suited towards our refinery sort of profile.
Thank you, Richard. So I think some of the key points to look at here, really, as we move through to the next slide, are really that supply growth in 2025 is expected to add, depending on who you look at, the last set of data from the EIA is 0.3 million barrels a day. I know the IEA in Europe has forecast that the surplus in 2025 will be 1 million barrels a day. And I think that's quite key to understanding, price direction, ultimately why oil prices are where they are today, given all the geopolitical concern, and what room that gives Trump and what that means the actual impact is likely to be of his deregulation, more laissez-faire policies. Against this backdrop, we are seeing a real slowdown in economics, part of Trump's obvious mantra in terms of his campaign was, to kill inflation, to grow the economy, to make people feel better again. And clearly, although the US is the leader in terms of economic performance and real GDP going into 2025, the current forecasts are still for a slowdown in growth. The advanced economies being led by the US, but the big news story is China. China really struggling to hold on to that 5% growth. The IMF in their latest data has got 2025 pegged at 4.5%. So generally a really static environment globally, and through some of the big consumers, real downdraft in terms of what we're seeing in terms of economic growth. Okay, so if we look at the next slide, I think. So I think one of the other things to really understand with both oil and gas is the real difficulty in shifting some of crude around the world, getting it to where it needs to be. Obviously, it's a very waterborne market, and we're seeing that transition in natural gas, certainly over the last couple of years. But here we've got the Straits, the Red Sea, and the Bab el-Mandab Strait, the Yemeni issue. Really, that has caused all sorts of indications where a lot of impact is being made there by making either things be rerouted around Africa, adding multiple days to numbers. I think the latest set of data shows that oil and LNG tankers are measured in, tens of thousands of dollars an hour, hundreds of thousands of dollars a day, and just adding 8 days to the transit is something that has real implication. But I think in the real key to understanding this is the region itself transits 25% of the world's oil supply and around 20% of the world's LNG, which is a significant volume. The implications for that in terms of what we're seeing in the current Middle East issues is that all of it passes through a 6-mile navigable strait called the Straits of Hormuz. That has always been contentious and is always quite difficult. The Revolutionary Guard in Iran is quite known for sending out and diverting and attacking shipping, or having shipping pulled into Iran for checks. So I think what we need to understand is that this is a crucial area just for the transit of oil and natural gas from Kuwait, from Iraq, from parts of Saudi. There is a pipeline, but not everything goes through that pipeline. And the key thing, perhaps, and I don't want to really labour on it now because we're going to talk about LNG shortly, is that the second largest supplier of LNG in the world, 100% of their output gets pushed through the Straits of Hormuz. So if there was disruption to shipping there, the impact on the global movement of oil and getting oil where it needed to be would certainly be disruptive to the market, to say the least.
And this comes back, and I'm sorry to interrupt, Jason, but this comes back again to foreign policy, yeah? Should the tensions between Israel and Iran continue to grow, and one could argue, and again, this is supposition, so I don't want to put it as more than that, but if Trump comes back and continues to remove any restrictions on Israel and continues to put greater sanctions on Iran, one has to wonder what Iran's response to all of this will be. And one of its responses, and one of one of the areas that is critical to the global economy, and particularly the energy economy, are the Straits of Hormuz. And if there's any interruption there, that will have significant impact, whether it's long or short, significant impact on the energy infrastructure and energy pricing around the globe.
Okay, so in terms of US energy market impact, oil markets, as I said, as we've laid out before, US is currently the world's largest single nation oil producer, 13.4 million barrels a day, comfortably ahead of both Russia and the output from Saudi, which are struggling in the 9 to 10 million barrel a day categories at the moment. So, by a margin, the US is the largest crude producer. It is expected to average 13.14 million overall at the end of this year. And it is expected to grow again as we move forward. And that's without taking into consideration any of the likely impacts of what a new administration will do in terms of deregulation. But I think, the deregulation will come. And I think one of the most important things to really understand is that, the fact that Chris Wright, one of a leading shale fracking guy, has been the pick to become the energy secretary. He's also got energy favourable people in all sorts of key positions or suggested to be energy SARs. And I think the real policy direction is obvious, but I think what we want to say, and Richard and I have discussed it a number of times now, is that this is a global market and the price will ultimately, you can deregulate and you can allow things to happen, but unless the market is there and the price is right, the actual impact, we believe, will probably be much more moderate. So production in the US will undoubtedly increase through 25 and beyond, but it will be incremental demand. And by that, what I mean to say is US demand is forecast to grow, global demand is forecast to grow, the US's share will grow, but it is still only going to happen if the investment case is there. And I think that is something that is, not really discussed at great length.
Yeah, and maybe Jason, if I can add to that thought, no doubt, Chris Wright, who's the CEO of one of the biggest fracking companies in the U.S., and Doug Burgum, who is the governor of North Dakota, which is one of the biggest, I would say, markets for fracking and shale oil and gas. These people are fossil fuel devotees, and they will be focused on lifting regulation, helping the fossil fuel industry, and de-emphasizing any, let's say, benefits to the energy transition and sustainable world. Doesn't mean that sustainability will stop. I still think CEOs will be looking towards the long term, but it certainly will slow the transition. And as Jason said, will be supportive of production, but nonetheless, if prices remain low and WTI is trading in the mid 60s today, unless prices increase and that's seen as a sustainable increase, it's hard to see these large organizations making substantial investments, which are significant in duration, for pricing at the low end of the spectrum. So yes, we may get an incremental sort of production bump, but ultimately, as Jason said, whether it's a sustained production bump in a bigger way will be driven by market factors, not so much by the individual regulations and restrictions. What we probably will see is more pipeline development, ability to move things around from North Dakota to the Gulf, from Pennsylvania to other places. That will certainly unlock some of the benefits. But the idea of greater production, that's still a little bit of a jury out because we'll have to look at the economics behind it rather than solely the drill baby drill mentality and regulatory relief behind it.
Yeah, thank you, Richard. I think just coming in on that, allowing people to do something is not necessarily the business case.
Right.
That we may find that driverless taxis, courtesy of Trump's allies, is possible, but technically, can it be achieved? Just because you don't ban it doesn't mean to say it can happen. I think one of the other key tenets of the impact on oil markets and energy markets is the blanket importation tariff threat of between 10 and 20% on all imports. The truth is a third of overall demand in the US, because of, as Richard said, the issues with light and sour crudes. A third of US demand is imported. Now, obviously, that's in great shape compared to a few years ago, but putting 10 or 20% on a third of your oil importation as the world's largest consumer of crude is going to be massively inflationary.
And certainly from a US standpoint, where the price of petrol or gasoline is always a hot topic with your constituents, putting a tariff on imported crude certainly will get a lot of attention. So it may be an area of a carve out. It may be something else, but certainly something to watch. And I would think not something a populist would like to see done if he can avoid it.
No. I think the key note there is that over 4.5 million barrels a day comes just from Canada and Mexico alone. So the talk is already of at very least Canada and possibly Mexico being exempted from that import duty. We're still a long way out from inauguration, a lot of twists and turns, but make no mistake, it's a very sensitive area, and a 10% tariff on a third of the US's oil consumption would have a massive and lasting impact. And perhaps I'll just leave this slide here when I say, if US output were to grow by 5% annually, and I said we think that it's incremental rather than a big bang. I think we've had the big bang effectively. The US would only reduce its import requirement by less than 2 million barrels a day by the end of the decade. And, Trump is only engaged until 29. So, I think I'll leave you with that. I think that's quite key. Moving on to the global impacts, I think one of the key things for me in terms of the global oil price is Iran. Richard's talked and outlined it, so I won't replicate that. But maximum pressure, something a few of us that were around during the first Trump administration can remember. The US policy towards Iran was incredibly aggressive. It was maximum sanctions. It was a tearing up of the JCPOA. It was, the rest of the world, and particularly Europe's work on the nuclear and sanctions deal with Iran thrown in the bin. I think this really does have significant, potential. I think it's probably fair to say that, Iran will probably be take a back seat to, depending on events, of course. One always has to be reactionary as well as proactive in these environments. But I think Russia, Ukraine is something that I think Trump thinks he can quite quickly move on. And, he wants a result and he wants a positive result. Looks good for him. Probably, gives the world. So Iran, maximum pressure 2, I think that's probably a given. And any escalation in the region, has serious consequences. I think the upside for that is possibly, there are market people out there today that say that WTI, Brent are trading 65 to 75, depending on the grade, purely because there are these tensions, and that it'd be, it'd have a 5 handle on the front of it if it didn't. I think that's probably quite aggressive, but I think, Trump will be very, very keenly aware that, a little bit of volatility here will probably help the case for, the expansion in oil. As I said, if the price collapses, the case for the expansion collapses as well. But I think in the short term, we need to look to a faster resolution. If a fast resolution to Gaza or something like that de-escalates, that would generally be positive and would really push some downward pressure and refocusing on the economics in this area. But I think, certainly my view is that I think Iran will be left to stew a little bit. I think the focus will be Russia, Ukraine.
Yeah, and maybe Jason, just sorry to interrupt you here, but interestingly enough, if you think about it, if someone were to describe a scenario in January that the Russia-Ukraine war would be heating up and Ukraine would be taking territory in Russia, Israel was having a war in Gaza and now has entered Lebanon and had direct conflict with Iran, and someone said to you, predict the price of oil, you would most likely be in the 90s or 100s. But the fact is we're trading in the 60s, low 70s. I think that's a testament to the fact that economic growth, particularly driven out of China, has been so slow, so weak. As a consequence, even with this type of, let's call it geopolitical instability, the oil markets really can't catch a strong bid. And that looks to continue with supply robust and demand looking quite, sort of weak. The only thing that certainly could change that dynamic, and whether it changes it longer term or short, would be some sort of intensification of any of these conflicts, right? And that could be very short-lived.
Mm-hmm. I think if we look at that Russia-Ukraine issue, they don't have the Straits of Hormuz, they don't have the Red Sea angle, right? That oil, the sanctions are, where there are energy sanctions, they are oil against Russia. There are more holes in the gas ban than or the restrictions on natural gas than there are blockages. But in terms of oil, it's fairly uniform. That oil is still coming out into the market. Latest production figures, independent figures, they're producing 9 million barrels a day in Russia. That's not. They're still a significant player, and they're still selling to China, India, and a number of other countries, and including some perhaps not really talked about rebadging of oil, bed and breakfasting. I think even some European states have been accused of that in recent months.
Great.
I also think, one of the big things in terms of if you look wider and look at the tariffs, is that the pressure being lifted off of Europe by a resolution to Russia-Ukraine, a deal, will just take assuming one gets gas and oil back into the market from from Russia. It takes a huge pressure off of Europe economically, and why Europe has been flatlining in economic growth terms. And quite frankly, if I can be so bold, that's not a US priority, or
No,
not a Trump priority.
no, agreed. And maybe just in the sake of time to wrap up the oil discussion, I think our view is oil remains weak, yeah, and may get weaker on a Ukrainian resolution, yeah, unless there's some change on a geopolitical side. But right now, looking out at least into 2025, the oil market looks exceedingly well supplied. Demand looks modest at best. So as a consequence, we see slack in the crude oil markets, but that's always with the caveat, geopolitical events can always upend the underlying fundamentals from that side. Yep. Maybe we'll turn to gas, yeah?
Yep. So again, if we look at some key data points, I think LNG, the market or the suppliers for LNG globally are the US, number one, and then a point of contention, but generally speaking, Qatar number two, Australia number three. Australia, I'm not really going to focus on here. Why? Because they're not committed to a massive expansionary program over the next 10 years for cost reasons, very expensive in labour terms, and also in terms of the Australian view on renewables. They're not as petrochemical friendly as Qatar and the US at this point. So I think Australia is a big player in LNG, but it's relatively static going forward. I think what you can see from the LNG exports there is that while there has been growth, particularly in the US, the Australian market, as I said, has remained really static since 22. In fact, actually slightly lower. And in terms of Qatar, there's been no real growth either. That obviously changes, and we'll be talking about that as we go through the slides. But both the US, who have carved this market out to become the world's number one LNG exporter, and Qatar are in a race to the bottom for 2029, 2030, where both will Qatar will almost double its production. The US will more than double current production and export levels from today's number one position. So I mean that really is significant. I think just in terms of what that means, particularly with the focus on Europe, is that the US in 2023 was sending 70% of its flows to Europe. That really has changed this year. Why has it changed? Well, Europe's imports have fallen by 35 BCM this year. That extra demand is going to Asia, and it's flipped this year's balance to pretty much 50-50, but just slightly in favour of Asia. Not so much on price, because price has been relatively flat across the Japanese Korean marker and the TTF. But in terms of what we're seeing going forward, is we're seeing this shift of production. We're seeing a big increase in production. And whilst we still have problems with shipping routes, particularly through the Red Sea, I think you can say that the big production bumps in US production, which we'll talk about in a minute when we look at some of the later slides, means that Europe will see more LNG before the end of 2025. I think if you look in terms of exports, you can see here relatively small. So US production is pretty much flat for 24-5. In fact, actually a slight reduction. But you can see that exports continue to grow out of the US. And I mean, why wouldn't they? the export price is 4 to 5 times higher than the domestic gas price. I'm not sure there's really any more to add on that, Richard, unless you want to add something.
Just one quick point that's probably worth adding. When you think about LNG flows, at least traditionally, and as Jason pointed out, they are always subject to change. I always try to think of it as Australia sends the bulk of its LNG over to Japan, South Korea, China, Singapore, Taiwan. That's where the bulk of it goes. The US, and that has changed as Jason pointed out, but traditionally sends most of it to Europe and the rest of it, the residual goes into Asia. That's sort of flipped. And Qatar, at least historically, was sort of split. It would come through the Straits of Hormuz, half of it would go east, half of it would go west, come up through the Suez Canal into the Mediterranean, into Europe. That's sort of changed for a couple of reasons. One, Europe's storage has been full and quite robust. And two, it's very difficult to traverse the Bab el Mandab right now. And therefore, that longer trip around the Cape of Good Hope adds a lot of cost and time. So it's much more economical to ship out to Asia if prices are similar. So, don't underestimate how the Houthis have changed the flow of energy by just making it more difficult to traverse that strait and changing the economics and the dynamic of the shipping of LNG across the globe. I think that's just one point to add to that.
Mm-hmm.
Yep. Sorry, Jason, I'll move forward on the slides.
Yeah. So I think if we look in US energy market terms, natural gas and LNG, markets flattened off. Production levels in US gas this year have dipped purely because prices are not conducive to, a lot more investment. Obviously, as we think less regulation and more promotion will certainly, drive the Trump agenda through 2025. Clearly, the market is on exports. We've already seen that, we've already got confirmed by the EIA before Trump takes office that we expect to see 120% increase before 2028, the end of 2028, from current production projects. But with the lifting of the moratorium on new LNG licenses, which would surely accompany a Trump administration, that will only accelerate. Again, how fast that accelerates will depend on the market. But by 2028, as I said, there to put some numbers on the narrative, 200 million tons of LNG will be exported compared to today's 93 million tons. That's a significant game changer, especially if there is a resolution in somewhere like Russia, Ukraine, which reopens pipeline gas into Europe as well. But again, I think, it's important to see that in terms of in domestic terms, there is a stall at 90 billion cubic feet a day in terms of US gas production, driven by price. So the expansion and the out for US gas is export.
Agreed. I think you raise a very good point there. The real unknown at this point in time is, what does that Ukraine resolution look like? And does it unbottle those sanctions and allow more gas to flow? As you pointed out, Russia is still exporting a lot of gas in the form of LNG and others, but they're infrastructure constrained. If they can really open up their pipeline network and trade again with Europe, that will change the gas dynamic and the LNG dynamic, because piped gas traditionally is cheaper than LNG. So certainly things will change a lot. So all eyes will be focused on whatever negotiation Trump forces in Ukraine. That will dramatically change the trajectory of the gas markets.
Yeah, and just to sort of really tie all that together, going through the global energy market impacts, I think the key thing for me, if we look at the Russia-Ukraine thing there, is before before 2022, 425 million cubic meters a day of Russian gas arrived in Europe. That is significant. It would be foolish to think for one moment that having carved the market for export, any resolution would see that return in anything like that quantity back into Europe. But I think it would be very reasonable to assume that not only is Nord Stream dead, but that as part of the rebuilding and the economic rehabilitation of Ukraine, using their gas network and re-importing gas into Europe would be a key part of that. So I think that really is one to look at, and that's really, really quite positive. Lifting of restrictions on US LNG export projects, as I said, I think, at the moment we're looking at around a 50-50, in fact, 50-45 split in US. But I think, naturally speaking, as there's this race to the bottom in LNG before the end of the Trump term, the end of the decade, you're going to naturally see the US, from its current position, favouring Europe. And therefore, I think that also underlines the fact that Russian pipeline gas in the magnitude of 425 million cubic meters a day is not returning to Europe anytime soon. In terms of the Middle East, I think really it's again, I think there's two things for Europe specifically, not just on a global basis, but the whole Egypt thing's been an issue. Israel is now a regional significant player in natural gas. Its fields off of its coast near Cyprus and have been producing about 10 BCM, of which Egypt's LNG has been taking 8 and re-exporting to Europe 6. All of that virtually has disappeared. I think the numbers are in the 0.2 and 0.3s at the moment on a monthly basis. So that's changed the dynamic too. Any resolution there, therefore, would have a positive impact on the European price by just taking some of that stalled capacity that wasn't arriving out of Egypt back into the game. But I think Iran is the key thing. I don't think anybody thinks at this stage that anybody is going to start attacking Qatari LNG facilities. However, if we've got the Sixth Fleet actively going up and down the Straits of Hormuz, and there being some skirmishes between Revolutionary Guard and allied shipping, I think it would be entirely possible for Qatari LNG exports to be significantly disrupted.
And I think that just paints the picture of market still well supplied, but volatility ahead, assuming geopolitical risk is continuing to grow. And for those organizations that can't assume some of that risk, which could be short-lived, but very, very sort of significant in the sense of price variation on any given day, how to hedge some of that and take some of that risk off the table is something for consideration.
Okay, I think just to wrap it up from my point of view, Richard, I think the electricity markets, key information here, really one of the biggest drivers for electricity prices globally and certainly in Europe is fuel input costs. Marginal cost, the marginal kilowatt hour, if you like, is still very, very key. And while there are lots of exceptions in Europe, power seldom does not follow the trend set in oil. Different paces, different speeds. some disconnections, the Nordics, Spain, France, all three large exceptions there. But power generally, and I've even included Japan here as a huge key buyer to generate of LNG to generate electricity, especially with, although its nuclear response to post Fukushima is to increase the amount of availability in rehabilitation. That is very slow in terms of the number of nuclear plants coming back online. So really, I think to see power, you must see power in terms of what the gas and the oil price are doing, purely and simply because they are, power markets are in good shape in Europe. We're seeing EDF of hitting some great numbers on their reforecasting their availability of their nuclear fleet. Obviously, the wind and solar revolution continues to happen across Europe. We're seeing, very low prices on the spot in Q2 last year because of the amount of PV and a relatively windy point. But for me, power markets are just a derivative of their fuel input costs, and in the short term, i.e. 25, 26, 27, that still means you need to be looking at the gas price, you need to be looking at the oil price, and you need to be looking at the carbon price. And in the current climate, while it is unlikely that Europe is going to abandon carbon trading, with the US an unwilling and a blocking partner in terms of any global ambitions, I think, seeing carbon back at 100 euros a tonne is not something, given the economic headwinds that we may see from tariffs and the like, is not something that the politicians will want to get a handle on. So I think carbon will, relatively speaking, as it has done since the peaks of 100 plus in 23, will not be, in terms of euros per metric tonne, will not figure. And I know that might seem a little bit rushed, but I just wanted to sort of say, power markets follow the gas market, follow the oil market. They will be and carbon, and they will be your indication, because the pinch points are not in capability for Northwest Europe in the coming years, or 2 or 3 years.
Jason, thank you. And I know we're right on schedule, right on time here. Maybe just one quick closing remark. I think what you take away from what we discussed today is, from our point of view, Jason's, myself, other analysts over at NUS Consulting Group, our view is, if you look across the energy sort of spectrum today on a pure fundamental basis, from a standpoint of a consumer, large industrial, commercial consumer, the markets are quite good, right? There's lots of supply from the LNG standpoint. There's lots of supply from the oil standpoint. Demand is growing at best case, but modestly. As a consequence, this is why we've seen lower crude oil prices. Yes, we have seen an increase in the price of natural gas in Europe. The low point was in February or Marchish, if I'm right, Jason. We recommended to our clients, I believe in April, to hedge out a big chunk of the winter. Prices have risen from there. I think that's largely based on geopolitical issues and winter. Winter comes every year, but winter always seems to surprise the market. But nonetheless, coming out of the season, we don't see any reason for the markets to continue their assault higher. The big issue is this, and the thing to take away is, while the markets look well positioned from a fundamental standpoint, the new Trump administration creates something that we haven't seen in a while, which is this uncertainty of policy coming out of the United States. And that has the potential to disrupt a significant amount of geopolitical issues that will impact, have knock-on effects or side effects on the energy flow of energy and on the production of energy as a whole. One question we did have was, do we see the Trump policies having any impact on things like community solar here in the US and the like? The answer to that is probably no. Most community solar that's already built probably will have no impact at all. If it has any impact going forward, it might be on the construction of new projects. Yeah, because if some of the incentives are removed and the requirements are different, costs may be different, and then the investment case may be slightly different. So I don't think it'll have an impact on existing facilities and existing tariffs, existing opportunities, but maybe going forward, it may slow the additionality in that area of the market in the US. And then the last question that someone raised that we haven't answered already was, what type of percentage changes do we see in the US and Europe? And that's difficult to answer in a sense of percentages, but the idea is right now we see markets, as we said, fairly well supplied, modest demand growth. So we don't see any real pressure on prices. What we do see is the case for increased volatility growing substantially. So that risk profile of waking up one morning and prices increasing, 20, 30% is very possible. We're going to go back into a world where we wake up every morning and we're looking at X or Twitter and the news to see what happened when we were sleeping and how it's impacting the overall markets. And that's a very uncomfortable position to be in, but unfortunately, it's where we stand today. And that means recalibrating our risk assessments and recalibrating the amount of risk based on how much risk we can assume. Yeah. So with that, Jason, anything you want to top and tail on that?
No, I think I think it's the markets are definitely geared in terms of this is a risk play.
Yeah.
The current markets are all about risk. There is no immediate threat to the supply-demand balance, given the free movement of energy based on 2025 forecasts and economic growth as they stand. Clearly, if there is a geopolitical factor, anything is possible. But as Richard said, I think there is a forward bias of electricity and gas and even oil are going to have to face some pretty volatile markets. Ultimately, I think the case for the downside in Europe without geopolitics is going to play out during 2025. If we get one of those strands of geopolitics resolved or part resolved, and that would be Russia, Ukraine most likely,
Yes.
then a lot of the pressure comes out of the market and the view of risk in some of these forwards disappears. The markets, there's no demand forecast for winter this year in any of the gas demand states. So if you look at Asia's warmer than normal. Europe, despite the fact we're going into the first test of winter now, is above the 10-year average this winter. And most of the states, with the exception of some of the northern Canadian border parts, are forecast for a warmer than average winter on the latest going forecasts. So I think, the quantifiables are bearish. The appetite for risk is huge. No one wants to write those blank checks.
Agreed. Maybe we'll leave it there because we're a couple of minutes over. Thank you very much for everybody who attended. We will be circulating the slide deck to our offices and the consultants. So if you'd like a copy, contact your consultant and they'll be happy to forward to you. And we will be putting we recorded this session, so we will be putting a copy up on our website for your colleagues who weren't able to make today's webinar. But thanks again for your participation. Thank you for your questions. And hopefully we'll be doing this again in the next month or two when we have a little more clarity now that once Trump is in office and starts to implement some of these policies, particularly, as Jason pointed out, if there is a resolution to Ukraine, that will have reverberations throughout the market, certainly something we would want to be in front of and comment on. So we look forward to speaking to you then. Until then, have a wonderful day.